If you're anything like me, you've probably thought, how should I be allocating my investments? Oftentimes, when we're looking at investment portfolios, we're dealing with matters of opinion, not matters of fact. And everyone has their opinion on what the best way to allocate investments are. But today, we're not going to be giving you an opinion, but rather we're going to be giving you some frameworks that can really simplify your investment portfolio to help you better understand how you're invested and how that at the end of the day can help you meet your goals. My name is Luke Turner, co-founder of Moment Private Wealth, where we help athletes and entrepreneurs get smarter with their money. So there's going to be 4 components to this video today. The first part of the video, we're going to talk through what actually makes up an investment portfolio, which I think you're going to be surprised at how we think about investment portfolios versus what we see really out in the marketplace. And then 2, we're going to talk about 3 basic buckets that we can break your assets into that are going to help you better accomplish your goals in the long term. So let's go ahead and dive right in. First, what is an investment portfolio? So I just mentioned you'd probably be surprised at what our answer is to this, but this is not just your public markets portfolios, meaning if I pulled up your brokerage accounts at Fidelity or Schwab or Goldman Sachs or UBS, this is not going to be only those positions. Rather, the way we think about it is anything that we can take money and we can actually invest into. So these are going to include assets such as privately held businesses, private real estate, rental real estate. Again, anything that you can invest money into. Because at the end of the day, likely your largest asset either today or in the past was a privately owned business. Now, as an entrepreneur, there's a high likelihood that 90+% of your net worth is going to be tied up in a privately held business. And it would be ridiculous not to include that in our asset allocation decision-making process. Because at the end of the day, you're unique as an entrepreneur, and we need to make sure that your investment allocation is taking into account that unique asset that you own. That's the first part. What is an investment portfolio? So making sure that we're taking into account all those different areas. Because we're not taking into account all those different areas, it's going to be very difficult to decide from a risk perspective where to allocate dollars. Next part we want to talk about here are the 3 buckets we're going to break things down into. So we're going to talk about the war chest, the growth strategy, and the aspirational strategy. Let's go ahead and dive right into the war chest. When we think about the war chest, this is going to be your bucket of assets that we want to make sure is there from a peace of mind perspective. When we think about the war chest in the sense that these are going to be dollars that we potentially are going to need in the next 12, 24 months, 36 months, assets that we know need to be there either for spending in our life or for things that are outside of our lifestyle. So when we think about this, oftentimes people ask me, well, how do I know how much money I should have in my war chest? And we really break this down into a couple basic questions. 1, what does it cost to be you? So meaning, what is your lifestyle? How much do you spend on a monthly, annual basis? 2, what are any additional capital expenditures that we know of that are out there that we can plan around? Because the last thing we want to do is be in a position that we're investing dollars into our growth strategy or aspirational strategy, and all of a sudden we get a phone call and we need $1 million or $500,000 because of something that happened in our business, or we're buying a new house, or we're updating our house, and we have to sell those assets at an opportune time. So our war chest is there for not only peace of mind, but also to make sure that when things come up in life, as they always do, there's always that unknown expense. We have assets there to fund those projects. Typically for the clients that we're working with, we see this typically fall somewhere between a 5 to 7 year lifestyle run rate. So if you were spending, say, $20,000 a month, $240,000 a year, typically we're going to have 5 to 7 years worth of that living expense set aside into our war chest assets. And now what you're probably wondering, now that you know how much we're typically allocating to the war chest, now let's think about what are the assets that actually go into the war chest. The assets that are going to go into the war chest are going to be things that are not going to have a ton of volatility, but rather are going to provide you a little bit of yield, a little bit of interest. So these are going to be assets such as government bonds, money market accounts, corporate bonds, municipal bonds, and potentially private credit. Again, when we think about that war chest, we're not trying to get the highest rate of return in these strategies, but rather we want to make sure that these assets are going to be there for us in the long run. That's our first bucket. All right, the second bucket that we're going to look at is our growth strategy. The thing about our growth strategy, this is what I would like to call our stay rich money. So you've done the hard thing, we've earned the funds. Now we need to make sure that we maintain them and we steadily grow them over a long period of time. And we think about this is going to be our growth strategy. When we think about the growth bucket, typically there's a couple of questions that we're going to ask to determine how much we actually need to put in this bucket. The first question is going to be, again, a fundamental one that we ask for the war chest, which is, what does it cost to be you? Everything revolves around what does our lifestyle look like? And depending on what our lifestyle looks like, that's going to determine how much risk we can actually take in the portfolio from a growth perspective. And the second piece is going to be, what is our time horizon? Because if we know what our time horizon is going to be, this is also going to affect how much money we can put in the growth strategy. We're not going to want to put assets in the growth strategy that we might need in the next 1 to 5 years. Because when we look at market cycles, typically market cycles that have severe downturns, think about 2008, 2009, think about oil embargo, these time periods are typically time periods that take about 5 to 7 years from peak to trough back to peak. And so for us, we never want to be putting money in a situation that we might have to sell it at a loss. Because over the course of a long period in time, market goes up 75% of the time annually. But that also means that 25% of the time it doesn't go up. So the longer we can stay engaged in the market, the better odds we are of getting that expected rate of return that we're looking for in our growth bucket. The second component to our growth bucket is, what are the assets that are actually going to go into the growth strategy? These are going to be items such as public real estate, public equities, and public alternatives. Public alternatives are typically investments that are traded publicly, but they're not correlated to the stock market, or they typically move in different directions than the stock market. And so for us, it's always a dynamic, it's a personal conversation to determine how much needs to go into our growth strategy. But the goal in this bucket is that we are going to get a higher expected rate of return than our war chest, but we also need to make sure we have enough time for these securities to mature. So that's our second bucket. So now let's move on to our third bucket. Our third bucket's our aspirational bucket. And I would say our aspirational bucket is one that a lot of people like to talk about, but it is the bucket that we need to make sure that we're filling up last. And the reason being is that when we think about the aspirational bucket, these are going to be investments that typically have a realistic chance that we can get the highest expected rate of return, but they're also the investments that realistically could return zero or have a significant risk of losing principal of the investment itself. When we think about our aspirational strategy, we're again going to ask that fundamental question. One, what does it cost to be you? Because if we don't know that question, we're never going to be able to fill up buckets 1 and 2 first, and then determine what actually needs to go in bucket 3. And then the second is, how much risk do we want to take? Because oftentimes when we look at bucket 3, there's typically not necessarily a right answer for how much needs to go in bucket 3, but there is a wrong answer. And the wrong answer is we put too much money in bucket 3, and that puts us in a situation that we are risking money that we need for money that we don't need. And so for us, it's always that balance of, there's not necessarily a right answer, but there certainly is a wrong answer. We never want to be in a position that we're overfunding bucket 3 using money that we need for the long term to fund our lifestyle. Because again, you've done the hard thing. We want to make sure that we're protecting the assets. So what are the types of investments that actually go into bucket 3? These are going to be investments such as private equity, venture capital, buying additional businesses that you might be operating, where there is a significant risk that you may lose principal, but there's also a significant upside over and above what we're going to see from an expected rate of return in buckets 1 and buckets 2. Just to recap, on your investment portfolio, we typically break this down into 3 buckets. We look at the war chest, which is the money we're going to have for peace of mind. This is going to be our 5 to 7 year bucket. Second bucket is going to be our growth strategy. Typically, this is going to fund the next 7 to 15 years, a higher expected rate of return than bucket 1, but also we need time for those investments to mature. And then aspirational bucket, which is bucket number 3. These are going to be our highest expected rate of return assets, but they're also going to have a downside of potentially a loss of principal of investment. So when you're building out your portfolio, always revert back to the goals that you have in mind. There is no perfect solution for an investment portfolio, but ideally you have an investment portfolio to fund your goals in your life. If you're not sure what you should be investing in from a portfolio perspective, or you don't feel like your investment portfolio is tailored to meet your goals, feel free to reach out in the comments below or follow the link to schedule a link with Moment Private Wealth. Thanks.